break it all down with Jud Pyle, portfolio manager at PEAK6 Advisors. He joins us from Chicago Board Options Exchange, and Hugh Johnson. He is one of the most accurate forecasters, accurate economists, I should say, in the world, which makes him a Bloomberg best. He is also an investor as chairman and chief investment officer of Hugh Johnson Advisors in Albany, New York. Gentlemen, thanks for joining us. You know, Hugh, let me get your take here on the economy and the market as we go forward. It seems like everyone has turned bullish. Doesn't it scare you a little bit when we're all bulls out there? Don't you want to be a contrarian just instinctively?
Well, you bet you do. When you start to see this level of bullishness with regard to the markets, it's usually a pretty bad sign. It's a time probably to get a little bit on the defensive side, but it also has to be coupled with overvaluation in the markets. You have to have extreme bullishness and extreme overvaluation to characterize an emotional extreme in the markets. And I think we've got the obviously the bullishness, but we don't have the evaluation side of the issue. So I'm a little less concerned, but obviously it's very troubling.
Hey, Hugh, it's Julie here. But what about the relative strength index on the S&P 500? I mean, that is at a quote-unquote oversold level right now. What are you looking at as your indication that things are getting a little stretched?
Oh, well, I don't think things are stretched at all. What I'm saying is that when you look at things being on the bullish, the percentage of advisors that are bullish or the percentage of individual investors that are bullish, that's very high. But on the valuation side of the thing, Julie, I don't think it being overstretched at all. In fact, one very simple and oversimplified way of looking at it is to compare the yield on a 10-year Treasury to the earnings yield on the S&P 500, or roughly 3.4% to the earnings yield on the S&P 500, which is 7.3%. This stock market is very attractive. It's obviously much more attractive than the bond market still, despite the fact that rates have moved up.
Hang on, I think Julie had her first slip of the tongue in 2011. It's at an overbought level.
Right, I didn't mean to say oversold.
And I want to, if I could, just ignore the bell for a minute. Let's pretend we're still trading and ask Jud what you think about that. Because is it a concern to you? Do you think we're overstretched here? How do you feel down there? Pretend you don't hear the bell.
Well, I think that what we've got going on, if you take a look, you mentioned it earlier, that this is the biggest update we've had in a month, but look at what happened in December. We obviously had great returns. What does that mean? That means we just drifted higher. I think what we're going to find here in the first week is we're going to determine if December's rally was a function of the fact of a lot of bona fide buying, or if it was just a lot of sellers not wanting to take risk into the end of the year. And so I think there's definitely a lot of tentativeness here. If we start to get any hint of a kind of sell-off, I think it'll be short-lived, but it could be kind of violent short-term as we get a little bit of a correction after the amount of buying that we've had.
All right, now with economist and investment strategist Hugh Johnson in Albany, portfolio manager Jud Pyle at the CBOE in Chicago. And Hugh, you can see why Zara wouldn't be that affected, since we've already had such an amazing run in 2009 and 2010 for equities. We've seen the economy start to recover. We got some positive numbers. Retail sales were pretty blockbuster this holiday season. Does that, on the economic side of things, does that continue to just rise and recover through 2011?
Well, look, the market's gone up, and the market's gone up sending us a message. And it's not just the market's gone up. As was mentioned, all the right sectors, consumer cyclicals, materials, industrials, and technology, the economically sensitive sectors in the market have done well, small and mid-cap. In other words, sending a signal. The signal is the economy is going to do well in 2011, and I think it is going to do well. You saw all of these economists raising their forecast for the outcome for GDP in 2011. It's getting pretty high. I think that's all well and good. I think the problem is at some point here is that there might be a shift, and there might be a shift in investors away from all of the things that everybody's caught up in right now, like cyclicals, like technology, like industrials, to the safer side of the market. Things like large cap stocks might outperform small cap stocks. You might start to see things like, well, financials, we're already seeing it, but telecommunications was mentioned. That might start to be a good performer. In other words, investors might at some point here say, look, we've overdone it. We've overstated the amount of the economic recovery that's really in the cards, and we have to now move to the defensive or safer side of the market. I think that's going to be the big surprise in 2011, that investors will start to play it safer.
I just want to point out that Byron says telecoms and utilities will underperform when he's talking about surprises.
That's right.
He also says that we're going to rally in the first half of the year as we get used to the idea that we're going to post 5% GDP growth and unemployment comes down below 9%, but then the market will correct in the second half. Do you take, besides your pick on telecoms there, do you take issue with any of those other predictions?
Well, yeah. I mean, when you say, first of all, 5% GDP growth in 2011, that's simply not in the cards in my judgment. I think the number's going to be, it depends on how you're measuring it year over year. I think if we get 3%, that'll be really a good year. So 5% is not in the cards. And the question really is, as soon as everybody wakes up to the reality, which is that 5% is not in the cards, that we're still going to have the drag of housing, what are investors going to do? And that's what I'm saying. I'm saying that investors, as soon as they catch up with that reality, and it's not a bad reality, it's just reality, when they catch up with that, they're going to start to play it safer, and you're going to see large companies as opposed to small companies, and then you might see some move towards telecommunications and utilities. So I think Byron might be wrong on the telecommunications and utility side of things.
Hey, Jud, let's kind of bring you back in the discussion here. Looking at the economics hat and the kind of investor hat out there, we're talking about this idea that in December, kind of November, we saw a huge kind of spark by the consumer, right? And a big retail numbers, kind of a lot of spending there, more hiring happening, unemployment's kind of gradually working its way down in terms of jobless claims. So with all of that, does that kind of fall away now that January and February are here and December and November are just gone?
Yeah, I think it is going to fall away, as you say, but I think there's a high probability it could be replaced by something else. For example, we've obviously seen a lot of M&A activity in the third and fourth quarter of 2010. I think that's going to continue, and what that does is that's basically taking equities out of the stock market because people are buying up those stocks. I think that everything that Hugh has pointed out is absolutely right from the standpoint of a macro side. You know, from a short-term trading perspective, what people are going to keep an eye on, it is still all about jobs, jobs, jobs. We got that big number coming on Friday, and then you got earnings season getting going next week with Alcoa coming out on January 10th. But yes, I think that the consumer-driven spending that you've seen, I think we'll see that start to tail off, but it could be replaced by something else.
Jud Pyle, Adam here. What causes you to change your mind and get concerned and take money off the table?
Well, I think for me, I'm a big believer in don't fight the Fed. If we suddenly see a dramatic shift, which I don't think is going to happen, but that'd be one thing where if we suddenly start to see the Fed say, hey, you know what, we've done enough with QE2, we're pulling out. That would be, I think, calamitous because the market is not expecting that to a large degree. I think another thing that for me, again, I said jobs, jobs, jobs. If this employment situation looks like it's not, if it starts to look like it's getting worse and people aren't hiring the way that I think they're going to, that would be the other thing that would start to make me change my tune. But I agree with Hugh. The earnings yield and the dividend yield of particularly some of these large cap S&P 500 companies, I think relative to bonds is just it's something that works. People can put their money in those big cap liquid stocks and do better than they would in bonds with what I think is limited downside.
All right. Hey, Jud, I want to thank you for coming on today. Jud Pyle there from the CBOE. Hugh Johnson, always a pleasure. One of our Bloomberg best. Hugh Johnson from Hugh Johnson Advisors.